listeners, welcome to this podcast series from ALPHABETA. Do you wonder who decides or what decides the price of a stock or a bond or gold or any other asset class for that matter? Do you ask yourself if you should buy now or sell now? And is the market going to crash or is it poised for a rebound? Don't worry, you're not alone in these type of predicaments. A lot of people, whether they are professional traders or whether they are new entrants into the market, have the same kind of questions. My name is Sundar and I, along with my colleague Sathya, will help you with the thought process to kind of take you through questions like these. We have both been at this for quite a long time, and we've seen some ups and some downs, and we've got the scars to prove it. And we hope to share some of those learnings with you through this podcast. Hi Sathya.
Hi Sundar. Hello listeners. Just like what Sundar mentioned, we will be picking up each of this topic in this podcast series and analyzing it from different viewpoints. Sundar is a technical analyst and a macro guy, and I'm a pure micro-fundamentalist.
So what we hope to do in this podcast series is to remove the noise and the jargon and the complexity that accompanies most of these conversations and make it interesting for you all.
It makes a lot of sense, Sundar. I am very kicked up and to conduct this series with you. Hello listeners, just a disclaimer, like any other show, please note the views expressed here is our individual opinions. It is not meant to provide you any investment recommendations.
Hello listeners, welcome back to our second in this series of podcasts from ALPHABETA. Today we are going to be covering a very interesting sector, one that is very close to most individuals, most households, the real estate sector. We all know that since generations, right from our grandfathers and our fathers, there has been a lot of affinity towards real estate as an investment avenue, as a physical asset itself. Today, of course, we'll be discussing different stocks and various other facets of the real estate sector. And as usual, Sathya is here with me, joining me for this podcast. Hi, Sathya.
Hello, Sundar. How are you doing?
I'm good, Sathya. Good.
Okay. Thank you, listeners, for joining us today, and hope you're all staying safe and staying healthy. And we have a very interesting topic lined up today. We're going to talk about the real estate sector. And specifically, we're going to talk about three companies, Prestige Estates, Brigade Enterprises, and Oberoi Realty. Together, they control a market share of around 25 to 30%. I will follow the same format. While I'm a micro-fundamentalist, we look at each of the individual companies. Sundar is a technical and a macro guy, and he's going to look at the macro environment as well as the technical attributes of these stocks, sir. And I am really excited what conclusion we're going to arrive today. And over to you, Sundar.
Yeah, thanks, Sathya. So before we start off on the fundamental and technical analysis part of it, let's quickly cover some of the major events and the macro environment around the real estate sector today. Real estate historically, it's been a favorite asset class of most of us. I mean, worldwide it's a favorite asset class. Everyone wants to own a home. And especially in India, there is also a concept of handing over wealth in the form of real estate or a house, from generation to generation. So it's a very favored sector, even for people, middle class, lower middle class, as well as the very rich people. So across all sectors of society, this is a very prominent and popular sector to invest in. However, till about 1992-93 or so, when the Indian economy actually liberalized under the Manmohan Singh government, the Indian real estate sector was fairly standalone, right? I mean, it was operating on its own parameters. But however, after liberalization, and especially post 2000, when post 95 and 2000, when the IT sector really started taking off, there were a lot of spin-off effects to the real estate sector. So a lot of prices started going up. There was a difference in the formats in terms of how the offerings were made, and so on and so forth. But however, the last 10 years have been quite momentous for the real estate sector. So we'll kind of go through that to set the stage of where we are today.
So Sundar, while you talked about real estate as a favored asset among the Indian populations,
right?
But do you think the mindset is changing because of these millennial coming in?
Absolutely. I think that's a very valid observation, Sathya. And the mindset is changing largely because I think the millennial segment of the population is oriented more towards experiences versus owning an asset. The earlier generations were more oriented towards owning an asset. That also has a spin-off effect on the type of real estate that's being sold today. We'll come to that in a bit.
Okay.
Right?
Okay.
So between 2011 to 13, the corporate landscape really changed, and it scaled up. And there was an approval for 51% FDI in multi-brand retail. So that kind of triggered a lot of interest in the retail segment of the real estate. In 2014-15, corporate giants started to implement growth plans, and demand for office space reached an all-time high in India. Parallelly, Real Estate Investment Trust, the platform, was approved by SEBI. And this opened up many avenues for funding and warranting some relief to the developers. Right? Now, in March 2016, RERA was introduced. This is the Real Estate Regulation and Development Act 2016. And this was mainly introduced with an objective to regulate developers, because a lot of developers were kind of, defaulting on delivery of product to customers. They were not paying back customers if they had not finished the projects on time and so on. So RERA was an attempt to actually clean up that sector and make sure that the customers got a good deal. And all projects which were launched from that date above a certain size were to be registered on RERA, which meant that they had to follow all the rules and regulations and everything else, as per RERA. So that also placed a kind of a discipline with the developers which they were not too used to earlier. Now, in November 2016 was a big body blow for the real estate sector, because that was when 8th of November 2016 was when demonetization was introduced, right? And that, as we all know, a large part of the real estate transaction was happening in cash, with unaccounted money. And the government wanted to really crack down on this, and demonetization, while it helped achieve so many other objectives, it really hit the real estate sector really hard. And a lot of developers really went into limbo after that. And because of this, even the offtake of units, of residential units and commercial units and so on, they started declining. In 2017-18, RERA combined with the new GST also was a paradigm shift in the way developers would operate. And they were not used to this, the completely organized method of operating, right? So this also kind of led to a lot of slowdown. So over the last 5-6 years, if you ask me, there has been a lot of slowdown in the real estate, both by way of price appreciation of the asset itself, as well as rules and regulations that brought about, and which led to a lot of transformative practices in the sector. But it all took a lot of time, as change. Adapting to change takes a lot of time with both the consumers as well as the.
So in a way, do you interpret, Sundar, all these regulations, it's all in terms of driving towards consolidations of this industry, and maybe giving the power to the consumer? Maybe that's what I'm interpreting of what is the intent of all these regulations, sir. And corporatizations of the entire real estate sector.
Absolutely,
right?
Absolutely.
Unorganized to organized sectors.
Absolutely. We are bang on, Sathya, because what all this has done is in a way what happened in the late 90s, early 2000 in the mutual fund industry, if you look at stocks, right? So coming back to the timeline, 2019 was when India's first REIT was listed on the stock exchanges. This was from the Embassy Office Parks, which is oversubscribed 2.57 times, fairly good response. In Q1 2020, really there was a bit of a decline in the absorption of space, and once COVID hit in March, the sector kind of seemed to completely collapse. I mean, there was no offtake, people were not buying up. Obviously, there was lockdown, and people could not venture out. So there was the big dip in demand for real estate. So everything went actually downhill, right? So
that you brought a very interesting point about this REITs, Real Estate Investment Trust. So is it kind of a gateway for HNIs, high net worth individuals, to invest in a commercial estate, because it's a big ticket item, right? Any commercial real estate is a big ticket item. Was it? I think it is the intent of REIT was to give it is about unlocking value for a company.
Correct.
It's unlocking value to the shareholders.
Correct.
Another is in terms of HNIs getting an entry towards commercial.
Not only HNIs, Satya. If you look at the smaller retail population, right, the common investor. they basically had no access to commercial real estate yields. Right? They could not really deploy the kind of capital that was required to build commercial real estate. And moreover, there was uncertainty in terms of, the tenant they get, they may not pay them on time and so on and so forth. So this was a way to kind of corporatize this whole sector so that not only HNIs but also retail people, to the extent that they could afford, can actually buy a piece of this REIT. And interestingly, REIT's dividends, REITs declare dividends every quarter based on the rentals that they receive. And these dividends are actually tax-free, which is very different even from equity. So they've been given a favorable treatment from a taxation perspective as well. So currently, REITs are yielding approximately 6 to 7%, which is a fairly good yield from a tax-free perspective for the retail
investors. It's a post-tax.
So 2020 was a bad year. It kind of the sentiment started improving somehow during the third quarter of 2020 once the lockdown restrictions were lifted. And the Mindspace Business Parks REIT came out with an IPO. This was really subscribed 12.86 times as compared to the 2.57 times in 2019 of Embassy. So this was received very well. And now actually both the REITs are trading at a premium to their issue price. I just want to wind up with one statistic, Sathya, before you take on the fundamental aspects of some of these companies. Very interestingly, the housing price index, which was launched in 2010-11, at that point in time, the average annual appreciation for real estate was close to about 15 to 20%, depending on the area, depending on the location, city, and so on. This has come down to approximately 4 to 5%, right, in 2020. Okay. So there has been a rapid deceleration in terms of the asset price escalation in real estate, while all these transformative changes were going on, with the inclusion of RERA, demonetization, etc.
So what do you say, Sundar? Are you alluding towards as a value investor, you should try to buy it when it is low, right? Are you alluding that?
Well, let us look at your analysis, fundamental analysis, right? And then we will see where to park our money, right? And then I'll come to technicals and we'll see what to do.
Okay, thank you, Sundar. Thank you. All right, so Sundar gave a very neat perspective about what has happened in the sector in the last 10 years and what kind of regulatory impacts it has gone through. I will start from where we left in the last podcast, where we said that as I'm a micro-fundamentalist, I typically want to analyze each of the company individually because I want to look at where there is a value opportunity for investing. So broadly, we said about there are two aspects you want to look into. One is whether the firm is consistently earning net profits. And the second factor is what factors can disturb the earnings of the companies, right? So these are the two things we're going to look at while evaluating a company. Broadly, these are two things while we'll talk about different factors as we analyze it. I want to give a perspective about what is the revenue mix or the sales mix for each of these companies, and in terms of where do they make the sales. So broadly, there are three revenue heads. One is from the sale of properties, residential properties. Number two is the lease rentals, which they generate from leasing out the commercial properties or the retail stores, like running a mall. And the third revenue stream is from the hospitality, where they run big hotel chains. Let's say, for example, the Holiday Inn chain is managed by Brigade Enterprises, right, and the Float is managed by Prestige, and some of the Western properties are managed by Oberoi Realty. Okay. Right. So these are the broad three revenue heads. And if you see the revenue mix for Brigade and Prestige, you will see the revenue mix are pretty much same, right? In terms of they get close to 85% of the revenue from residential property and the lease rentals. Whereas for Oberoi Realty, the revenue mix is close to 95 to 96%. So 95-96% of the revenues that come from sale of residential property and lease rentals. Okay. And only 5% from hospitality, from the hotel industry, sir.
That's very interesting.
So what does it tells you? It anecdotally tells you that there is a cash accruals which comes from lease rentals where the margins are pretty high. It is beneficial for a company like Oberoi Realty vis-a-vis Prestige or Brigade Enterprises, right? Okay, now looking at the first attribute when we want to look at micro-fundamentalism, which is about consistency of the earnings, sir. So when I looked at analyzed the annual reports, the sector is a completely cyclical industry, which means that the sector goes through certain cycles. There is a boom cycle, then there is a slowdown, then there is a recession, sir. And we have seen various cycle in 2008 to 2011, then again from 2017 to 2020, which is what we are seeing. And 2017 to 2020 was the demonetization was the trigger for a slowdown, right? Trigger for slowdowns. Correct. So one factor you will see that everybody goes through the cycle, right? Whether it is Oberoi, whether it is a Prestige or a Brigade, everybody goes through this cycle. And
do you think that this is in a way building overcapacity leads to this cyclical problem?
That's a very good question, right? In terms of now the question comes, how do I find a cycle, right? As an investor, because if you are entering the cycle at the wrong end of the cycle, which is the start of the recessions, you get hit very badly, right? So what is the indicator? Do you think there's an indicator, can you tell me what are the indicators I need to look for, whether there is a start of the cycle or it's an end of a cycle. It's a start of a boom cycle and an end of a boom cycle. So, but let me admit it is very, very difficult. Very difficult for retailers to even figure out when does the cycle start, when does it to end. But I can give you some kind of parameters to look for. One is your inventory. Like you talked about the inventory. And if you see that if there is an inventory building up, it's an indicator that maybe the cycle is ending, right? The boom cycle is ending. Then we are seeing some kind of a recession cycle there, right? So what did we say? We said that hey, from an earning perspective, it's an industry, cyclical industry, and we are going through a cycle. Can we say that 2020 is the end of a recessionary cycle and the start of a Q3 is the start of a boom cycle, sir? I will reserve my comment. I will come back when I look at other aspects, sir. The second aspect, when you're looking at the earnings of the companies, are the industry is a capital intensive industry, right? It requires a lot of capital inflows, sir. To funding new projects. So what does it tells you? Like, how do you fund new projects? Either I get my own capital, which is my owner's capital, equity capital, or I fund it through my accruals, the cash flows I generate my business, or I borrow from...
Another way these guys were actually funding new projects was through the people who bought flats themselves. Right? They'll take upfront money and that was used to actually build out, right?
Build out, because unless you do a good brand, you cannot control. Because now the consumer preference is also getting changed. Saying they prefer completed inventory vis-a-vis with the work in progress, right? Correct. So, will that mindset getting changed? What does it mean? That there is a lot of capital requirement, upfront capital requirements. So, it in a way, company which were able to sustain new projects through accruals and cash flows from the internal accruals were able to generate a long-term wealth to the investors. So let me give an example what I mean by this. Take Prestige and Brigade, because when you talked about the revenue mix for Prestige and Brigade are very much same. While the revenues, which is the sales, in the last 10 years, it has grown at a CAGR, compound annual growth rate of 18%. And the book value of the shares or the net worth of the firms are relatively undergrown as compared to Oberoi, right? So if you look at Oberoi, the CAGR of the revenue is 8%. Look at where is 8% and 18% between a Prestige and Brigade. But from a net worth, which is the book where you denote the net worth in terms of your book value of the shares, and they have done relatively better as compared to what...
Why has this happened, Sathya?
So which means that the margins, whatever, the leftover margin, which is net profit, which belong to the shareholders of the companies, a lot of the margins are getting eroded towards borrowing, financing cost.
Okay, could it also be because Oberoi, if I understand right, is largely Mumbai-centric, and the other two, Prestige and Brigade, are Bangalore-centric. I mean, they also have a pan-India presence, but large part of their revenues come from the Bangalore region, right? So could it be because the ticket sizes in Mumbai are high, their margins are also, Oberoi's margins also could be high?
That's true. Oberoi, an operating margin is 47%, vis-a-vis Prestige and Brigade. It's anywhere between 27 to 30%. Okay? Because the operating margin is also high and the net profit margin is also high. I'll give the net profit margin when I talk about the next section, during the next section, sir, right? So there are two aspects. One is about Oberoi was able to control a better EBITDA margin, which is my operating margin is better. Maybe it is Mumbai-centric and they have better brand in Mumbai. So those are the two aspects. So what do you say from earnings? If you look at the earnings are not consistent, right? So it's a cyclical industry. You need to know where the cycle starts, where they end it, things. Secondly, in terms of its capital intensive, company which has done long-term value creations are firm which has lower borrowings, right?
Right.
So those are the two conclusions from a earning perspective. Let's talk about the what factors can impact the earnings of the company, right? I'm not going to revisit what I talked about in the first podcast about the Michael Porter's 5 forces analysis. Broadly, we talked about in addition to the 5 forces, we look at 2 additional forces, which is the regulations and the source of funds.
Right.
There are 3 factors which might impact or impacting the real estate sectors, right? One is, I'll call the bargaining power of buyers. What has been the bargaining power of buyers? The second aspect is the regulation, and the third aspect is about source of funding, right? How do they company fund and where their fundings are, right? So if you go look at each of this revenue segment we talked about, which is the residential property revenue segment, commercial lease rentals segments, and the third aspect is about your hospitality or the hotel industries. So if you look at each of this, there are certain headwinds which is currently happening, right? So if you look at from a residential property, there are excess inventory, right? There are excess inventory, and government is also trying to get rid of this excess inventory in terms of starting the AIF funds, right? Alternative investment funds. So what does it mean? It means pricing power has come to the consumers, right? That's number one. From a residential property. From a commercial lease rentals, is also that catching word, right? Corporates are saying working from home is going to the next phenomena, and we're going to cut down on commercial real estates, right? In terms, I don't know how far it is going to post-COVID is going to.
You'll be very surprised, Sathya.
Yeah.
I recently heard from one of my friends that Brigade is promoting the World Trade Center in Perungudi in Chennai, right? Apparently, about 1.5 million square feet has already been taken up by Amazon and Caterpillar.
Yeah.
Now, this is very contrary to what we hear in the press about the commercial real estate, especially office space going down, everyone working from home.
Yeah.
Something on the ground seems to be very, very different. So I don't know who is right and what's happening.
And that's a very nice thing you put in. But there are 2 aspects to it, right? Both the positive and the negative side.
Right.
While one side of the story says that hey, I want to cut down my capital cost, and maybe it is a hybrid work model. But I also tend to believe that work from home need not be a continued phenomena. Correct. It's only a short-term phenomena. From a hospitality, we all know what's happening to the hotel industries. With the lockdown, nobody is want to venture out.
Hospitality may probably be the last to recover because it includes theaters, malls, where the crowding, we try to avoid crowding and so on. So
forth, right? Absolutely, right. So from a bargaining power of customers, there is a larger headwinds the real estate sector has to go through. What does it mean? It means an impact towards the margin of these companies, right? The second aspect, regulations, you covered in detail. I don't want to get into detail again. So regulation also hitting very badly, and it is also in a way that organizing the sector better, right? In terms of what it is. Correct. And more only people have stronger balance sheet continue to remaining there, right? Correct. And the third aspect is about source of funding. So if you look at the source of funding, the Prestige and Brigade, they have a very similar debt-equity ratio. So what I mean by debt-equity ratio, right? So what debt-equity ratio tells you is that, let's say they have a debt-equity ratio like Brigade has 1.6 and Prestige is something like 1.4, which means that for every 1 rupee funding from equity owner's capital, Brigade brings 1 rupee 60 paisa borrowing from external borrowings, and Prestige brings 1 rupees 40 paisa from external borrowings, right?
That's not really too bad, right? 1.4, 1.6 is not really too bad.
It's not too bad, but try to look at what Oberoi. Let me give you the Oberoi picture, right? The Oberoi picture is something like 0.18. Brigade net profit margin is something like 4.25%, and Prestige around 6.6%, and whereas your Oberoi margin is something like 30%. Net profit margin is 30%, right?
Wow, okay. Right. Which is where I think things like REITs and other formal ways of getting capital will really help them.
That's a very good point you brought in, Sundar, because the REITs really helps in terms of unlocking the value, right? Let's say, for example, what Prestige has also done is that they are retiring the debt. They got into the deal of Blackstone about close to 9,000 crores, right? In terms of retiring. The whole intent about retiring the debt, you can really say that finance costs are taking a great hit within Prestige and Brigade, and one of the reason, maybe that's one of the reason where Prestige also want to retire high cost debts.
I think that makes sense, Sathya, because typically the way developers make money is to sell new inventory, right? And so once they have capitalized on something, they build something, they're getting lease rental, especially in the commercial space. it makes sense to hive the off, get cash flow, and deploy it in newer projects where their margins can be better, rather than depending on just rental inflow.
So broadly, what I would want to conclude, while I talked about these are the factors, so I want to conclude that there is an oversupply, there is a consolidation that's happening in the industries there, and there are consumer preferences are getting changed. Right, and there is uncertainty how the post-COVID scenarios might turn out for commercial real estate. Sir, right, so that's how I'm going to conclude. And while these are the negative aspects of the sectors in terms of earnings, but there are also some green shots in sectors where pent-up demand, right? There are pent-up demand happening. And even if work from home is also, people are pushing people to buy larger homes.
Correct. Absolutely. That's a new trend that's coming.
Trend happening. People saying that, hey, my kid is also in the school, taking the classes in my home, and I have to do my work. So people want to look for larger properties.
Larger homes and own homes rather than depending on rental accommodation. Absolutely. Right? The people want to own their homes.
The homes,
and especially with the millennial population really exploding in India, right? And I think this is a stage when they are beginning to settle down in life. Get married, start a family, settle down in life. At this stage, maybe they prefer their own home as opposed to something that's rented out.
Right, exactly.
Yeah.
So, so that's what I will stop here. And I want to take your take, Sundar. What do you see from a technical chart?
Yeah, so from a technical standpoint, right, I mean, the Nifty Realty price chart, when we look at the daily charts, all these stocks that you mentioned, Oberoi, Brigade and Prestige, and including the Nifty Realty as a whole index, has really started breaking out. It started, taken very strong support around, when the real drop in prices happened in April, March, April. And now the Nifty Realty pricing chart, as well as all the three stocks that we have mentioned, have all encountered what is called as a golden crossover in October, November 2020. What is a golden crossover? A golden crossover is when two moving averages actually intersect and cross over each other, where the 50-day moving average crosses above the 200-day moving average. What this means is that lower period moving average, 50-day moving average, is the faster moving average, and the longer period moving average, 200-day, is the slower moving average. Whenever a faster moving average crosses above a slower moving average, there is typically an explosion in the price once that event happens, right? Okay. And all the three stocks that we've mentioned, right, including the Nifty Realty, has crossed over, and it is now, even in terms of the Fibonacci retracement level, it's going up. But coming from a multi-year downturn, I think this is a great sign for the stocks.
Okay, so do you think this sector is going to drive the next economic recovery?
It probably will. I just want to allude to a quote by Mark Twain, Sathya, in this. Mark Twain said, buy land, they don't make them anymore. Right? So, historically it's been proven that, land banks, land has been a very valuable asset, right? It's a store of value.
So now you know why Indian prefers real estate.
Yeah,
right?
Correct.
So there's nothing wrong in it.
Correct.
So always listen to your parents.
Yeah, I know. So looking at that fact, right? I mean, one of the trends that we are seeing overall, right? I mean, why are we really analyzing these three big real estate players, right? It is their ability to build large integrated communities, right? Rather than the standalone buildings and the individual houses that were there in the past. As I was telling you, the millennials and the younger generation have a preference towards experiences as opposed to owning an asset. And when you have large integrated communities, you also own an asset. At the same time, you are having the experience. Your kid can go to a creche nearby. There's a play area for your kid. If you are an avid sports fan, you can play tennis, badminton within the same complex. And many of these integrated facilities also have offices attached to them.
Okay, you can walk to your office and walk to your school.
Yeah, walk to your office, walk to school. Right? And there's a large area for people to walk around, to socialize and things like that. Right? So I think both from an older generation perspective, as well as the new millennials starting off in life and the kids and everything else, large integrated developments are probably the future. And these companies have the best ability to leverage their strengths to build such large integrated communities.
Okay. Right? And in fact, you think they may also have experience in building this integrated
absolutely. I mean, all of them have this kind of thing, and many of them are very close to, for example, public transportation such as metros and so on. Right? So the ability to create this environment for the consumer and give that experience is, I think, what will give these companies a big advantage in the future. And we're looking at it from a business point of view in the future.
Okay.
Yeah. So
what are you concluding, Sundar?
I am concluding this industry has a good future, but look at the price patterns, look at some of the technicals on the charts, and I think the worst is over.
Okay.
I think the worst is over. It's probably one way up over the next at least 4 to 5 years. Really, if you allude to your cycle theory, that it follows cycles, right? Next 3 to 4, 5 years should be good for the real estate industry. So it may be worthwhile, getting into some of these stocks. In addition to the RITs that we mentioned, that provide you, some consistent dividends as well.
Okay. While Sundar has given his verdict in terms of what he thinks, what is poised for the real estate sector, as well as to these 3 companies which we analyzed, I also feel in terms of, when we also looked at the fundamentals, and I also feel there are certain green shoots in the economy, right? One example is about HDFC, which is the largest housing loan processing companies in India, where they have close to 65% market share in housing loans, and where they're claiming that they have processed the lifetime high of housing loan applications, right? Maybe is an indicator of the pent-up demand coming in, people coming in aggressively buying it. A lot of factors, work from home factors, or people want to own home can look at it, or it's only a slight flip in what we're looking at, right? Because so we are not sure. We may have to see how the next quarter also goes in, but there are certain green shoots which I see in this sector, right, in terms of the housing loan applications or the government's initiatives in affordable housing.
Correct.
Right, affordable housing sectors are. And the third factor is about this AIF, alternate investment funds, where government also wants to hive off this excess inventories, right?
Correct.
So I also feel maybe the sector is poised for a growth. Maybe it will revive the economy, because typically when you see economy as in doldrums, you will see these infrastructures creating the jobs, right?
Correct.
So there is every one job created in real estate, it has a related impact across various sectors.
Correct.
Whether
Spin-off effect
in
Correct.
metal, cement, or as a case may be.
Correct.
Maybe government will poise towards additional measures to revive the sectors, and there are like this green shot is showing some signs. So as an investor, what I would recommend for people, like we looked at what we see in terms of the operating margins and the net profit margins, look for stronger balance sheet, look for a company which has able to control source funds through the accruals and better financing terms with their lenders, right? That's what I want to look at. And lastly, about firms who can unlock values, right? Unlock value to the shareholders.
Correct.
Could be in terms of RETs, or whether in terms of pre-leasing functions, as a case may be, right?
Also, all in all, a very interesting sector to look at, I think, from the future. Right?
Absolutely. Yeah. That's what I feel. In next time, both of us feel. Maybe this is one of the area where both of us.
Yeah, I'm glad we agreed on this, Sathya, today in today's episode.
All right, thank you very much. And so, what do you guys prefer? What do you guys think as an investors? Do you guys going to agree with us, or you also feel something different? We love to hear from you. If you like us, subscribe us in the podcast. We are in the Apple Podcast channel under Vital Signs. You can subscribe to our YouTube channels, ALPHABETA, or any of our social media channels. Thank you very much, and looking forward for another interesting episode next time. Thank you.